As you can probably imagine, our 50 United States have a wide discrepancy in the way that we tax retirement income. So location can definitely be an important consideration in financial planning for retirement. Hello everyone, I'm Tim Doehrmann, founder of Eagle Ridge Wealth Advisors, and in today's video, I'm going to discuss which states do not tax retirement income and the different nuances that go along with that. Now, some states will exempt all forms of retirement income from taxation, while others may tax distributions from IRAs or 401ks or pension payouts or even Social Security, just like ordinary income. So first, let's cover some retirement income tax basics. Most retirement income is subject to federal income taxes, including Social Security benefits, pension payments, and distributions from IRAs or 401ks or any retirement account. But remember, Roth IRA and Roth 401k distributions are not taxed since they were taxed prior to contribution. And contributions and gains can be withdrawn tax-free if the accounts are qualified and if you are older than age 59 and a half. Of course, there are many nuances, as I mentioned before, surrounding the taxation of retirement income. Even if certain states tax distributions, almost all states offer some form of tax relief for retirees, whether it's a tax cap, an income limit, or an exemption or other state tax break. And since states' tax laws are always changing, it's important to stay up to date with your state's tax commission. Our tax laws are written in pencil, right? They're always changing. First, there are 9 states with no income tax at all, and they are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. These states do not levy any income tax at all, whether it's from a paycheck or a retirement source. But even though New Hampshire does not have income tax on income, they do tax interest and dividends, just to keep it simple. Just kidding, it seems kind of arbitrary, doesn't it? A lot of things with our tax law do seem that way. Next, there are 4 states with no income tax on retirement income. And these 4 states are Illinois, Iowa, for individuals 55 and older, and Mississippi and Pennsylvania. And those last 2 are subject to the retirement plan requirements of that state. So these 4 states make specific exceptions for retirement income from 401ks, IRAs, pension distributions, and Social Security benefits. So the 9 states with no income tax at all, combined with the 4 states that exclude retirement income from taxes, well, that gives us 13 states that do not tax retirement income. What about Social Security specifically? Well, in most states, Social Security payments are exempt from taxes, but 10 states still tax Social Security, and they are Colorado, Connecticut, Kansas, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. Because as of 2024, Missouri and Nebraska no longer tax Social Security benefits. So that's great. And each state has its own policies offering breaks and or exemptions based on income and or age. So even in states that tax distributions, there's often tax relief options for retirees. And then next, we have 15 states with no tax on pensions. So these states include the 13 states that don't tax retirement income at all. And this includes Alabama and Hawaii, which do not tax pensions, but still tax 401k and IRA distributions. And of course, other states may provide credits and or exemptions for a portion of pension income. Also, there are a few states with minimal requirement tax obligations, like Georgia, for example, which waives taxes on Social Security, retirement benefits, and also allows a deduction of up to $65,000 per person for various other retirement income sources. So clearly, the landscape of state taxation on retirement income is very complicated. The variety of income caps to qualify for exemptions can vary greatly between states. Furthermore, the taxation of retirement benefits at the state level remains a changing landscape. State tax laws change just like federal tax laws. For instance, New Hampshire plans to phase out its 5% tax on dividends and interest by January 2027. And until then, the tax rate on dividend and interest income will gradually decrease each year until it reaches 0. So what's the bottom line? Well, when you're planning for retirement, minimizing unnecessary taxes is essential, but it's crucial not to let it dictate your overall strategy. Or as I like to say, we don't want to let the tax tail wag the dog. income taxes are just one aspect to consider. Some states with low or no income taxes may have high property taxes, higher sales taxes, and often other hidden taxes. For instance, as those of us living in Illinois can attest, even though Illinois does not tax retirement income, we have relatively high real estate taxes. So, as with any good plan, you need to think about what you want and where you want to be first, and then you need to create a roadmap to get there. Thanks, and I'll catch you in the next video. Once again, Tim Doehrmann here, founder of Eagle Ridge Wealth Advisors. And if you would like to see how we help our clients get the most out of their financial lives and retirement, please visit us at erwealth.com, and we hope to see you there.